Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In this video I want to share with you guys 5 companies that are undervalued at the moment according to Morningstar valuation. But before we get to that, I'm going to talk about a couple of things. As you can see, this is my portfolio right now, and don't be alarmed if you feel basically if you see the price is actually the value of the portfolio has come down quite a bit. Is because I've made a sell. So I've sold one of the companies that I've had in this portfolio for a very long time, since 2020. And yeah, I took the money out and I will be putting that money back into the basically buying a couple of new companies in the next couple of days. So stay tuned for that. Inshallah, I will let you know exactly what company I sold, why I sold that company, and what I will be doing with that money, inshallah. So the value of the portfolio, as you can see right now, is 114,395 pounds. That's what I wanted to say. And yeah, so some of that is in ETF, some of that in basically individual stocks. As you can see here, they basically, when it comes to the fear and greed index, we are right now neutral because we had a kind of okay week in comparison to the last week where the elections was happening, everything was going to the moon. This week it's been kind of okay. Again, like I've always said to you guys, this kind of gives us an idea where things are, where, you know, the investors are, but the basic what investors are doing right now. But we don't really care. We are long-term investors, and that's what we want to see. And inshallah, what we want to do is hold on to our companies for a very long time. As you can see, we've got a couple of companies reporting next week. For me, the most important one will be Intuit. That company has been in the portfolio for quite some time, especially in both portfolios, the family portfolio as well as the other one. If you want to get hold of the family portfolio, join us in the Patreon account where you get access to that portfolio as well as this portfolio that we're talking about now. I basically normally share a PDF version of both portfolios so you can actually see how many shares I own, basically what my breakdown is, and a lot more on that, inshallah. If you can join us, that would be absolutely amazing. So yeah, Intuit is reporting. There are a couple of other companies, Lowe's is reporting, and so on. And again, as I always say to you guys, it's not that basically important when it comes to these one-time kind of basically quarterly reports. What's important for us is the 5-year, 10-year from now on. Are these companies, you know, will this company be around? Will it be profitable, and so on? But the big one, the big one, is the Nvidia. Nvidia is we're waiting for it. We'll see what happens. Nvidia and Snowflake are reporting at the same time. Palo Alto Networks on that same day. So it will be interesting what happens on Wednesday. If Nvidia is going to drag the entire market forward, or is it going to come back down and the whole semi is completely collapsed. We will see whatever happens. And yeah, as always, I'm just gonna keep an eye on it and just move on, because no one knows exactly what happened this time last year to Nvidia. Again, this time next year, no one will care. Right, as always, I'm going to share with you guys, like I said, 5 companies. We're using the same sort of information that we're always looking for. We want to see if these companies pay any dividends. We want to see in terms of revenue, in terms of EPS, where they have been. We want to see if they're profitable, if they're actually using the money that they generate to reinvest in the business to generate more, basically, cash for us. We want to see if that cash is actually how much cash the companies have. We want to see the total return in the last 10 years. We want to see where the revenue is expected to be next year. We want to see the EPS, as well as, of course, the valuation, Morningstar valuation. I always use Morningstar valuation because I've always said, you know, many times in this channel, I feel like it's probably the one that where I feel comfortable, because I feel like they do give us a bit of a margin of safety in comparison to Wall Street valuations. So they do use discounted cash flow models, which are very realistic. Okay, right, let's have a look at the first one. The first company is Merck. Merck is one of the companies that I've had in the portfolio for quite some time. It has come down quite a bit. I think it's hitting that 52 low. So we'll see what happens in the next few weeks. If you want to know more about this company, watch my last video where I talked about the whole whole video was just dedicated to this company. So if you want to learn more about it, go away and do that. And as you can see, it's got market cap of 248 billion market cap right now. Current price is $96 per share, and according to Morningstar, they expect the price to be about 120. So it's basically down about 18% or so on. You get nice dividend yield. You get basically over 3%. You get Dividend payout ratio is quite low, and then the safety is a B plus. The 5-year in terms of revenue, in terms of EPS is really good. Profit margin, return on equity, return on invested capital, absolutely wonderful. Free cash flow right now about $13 billion. The free cash flow yield of 5%. Total return the last 10 years we're looking at about 8%, and then they're expecting the earnings to grow, the revenue grow about 6%, and the EPS about 22%. Now if we look at Seeking Alpha, okay, as you can see here, we've got 17 strong buys, 6 buys, and then 6 holds, and that means about 36%, 37% basically upside from where we are. $131 per share is where they think the price should be. The next one that we're looking at today is Adobe. Is another company that I have been talking about for quite some time. I really like the business model. I do own this company. So yeah, right now 233 billion market cap, wide economic moat, $500, just over $500 per share. They don't have any dividends. I genuinely think probably next couple of years this company will start paying dividends, because they do have some free cash flow, which is quite nice. So I'm sure they will use that at some point. The 5-year revenue compounded annual growth rate is 14%, and the EPS is about 18%. Profit margin 25%, return on equity of 35%, return on invested capital of 36%, and free cash flow $6.5 billion. Free cash flow yield of 3%, and total return the last 10 years we're looking at about 22%. Growth estimate next year when it comes to revenue 11%, EPS is 13%, 17% discounted right now, $635 per share is where they think the price should be. I kind of agree with them, and I think this is this is still undervalued a lot, and it has been trading down when there were some of the big boys have been going up a lot. Again, I genuinely believe this is one of the AI plays as well. So 1 year is down about 15%. A year to date is about 15.6%, almost 16% down. Last 6 months is up about just 4%, and just for this 1 month is up down about almost 3%. The current PE is about forward PE is about 27, and as you can see here, just quickly show you the expectations for this company when it comes to EPS growth year over year. They're expecting double digits. And same goes for the revenue side of things. So I genuinely think this is a high quality business. And ratings from Wall Street, as you can see here, we've got 20 strong buys, 9 buys, 7 holds, 2 sells, and 1 strong sell, and $612 per share right now. It's about 22% upside from where we are right now, which is basically a lot if you think about it. Now, the next company we're looking at today is ASML, another one that I have been talking about lately. It has come down quite a bit. Because they kind of, when they reported the earnings, which was a day early, and a lot has happened within that, the guidance slightly lower. There's so many things happening with this company right now, and a lot of it is, to be honest with you, Wall Street takes it as a negative. I take it as an opportunity, and I have been adding to it, and I'll share with you guys how many shares of this company I own right now. 277 billion market cap, wide economic moat, $658 per share right now. Dividend yield is about closer to 1%. The payout ratio only 10%, which is quite nice. The 5-year growth rate of 23%, and dividend streak of 1 year. Annually, basically, this is, by the way, all this information comes from Seeking Alpha. From now on, I'm just going to use Seeking Alpha because I do genuinely have a subscription for it. So, and they have everything I need, so I'm going to use them from now on. So 4.8 when it comes to the annual. That's not the price. The dividend basically payout, the annual payout is $6.71, which is basically what you see here. If you go to Seeking Alpha, that's basically what you will see. And when it comes to, it's basically C minus. The 5-year growth rate and the 5-year growth rate for revenue and EPS was absolutely amazing. Profit margin, return on equity, return on invested capital. There's not that many companies that have in this sort of a range, which is quite nice. Free cash flow right now over over $3 billion. Free cash flow yield of just 1%. Total return the last 10 years 22%. Growth estimate for next year when it comes to the revenue side of it 15%, EPS 25%. 25%, which is absolutely huge. 26% discount right now, $935 per share. That's what they expect the price to be. Right now, 21 strong buys, 8 buys, 10 holds, no sales whatsoever. Their price tag is $913 per share. That's about 28% up, 38% upside from where we are right now, which is absolutely huge. So 26% here, over 30% on the other one. Now, AstraZeneca is another one. This company, there's a bit of an issue going on with China, so we'll see how that plans out. in the next few weeks. Again, is one of those companies that I do own in the portfolio. Basically, while it's down a lot, I might start nibbling again because I really like the business model. Is UK based company. Whatever is happening right now in China, it will pass. And of course, China is a more important market for them. So whatever it is, I'm sure they will sort it out. These type of companies do not just go down without a fight, and I'm sure whatever it is, they will sort out in the next few months. But again, as basically, pharmaceutical companies are sort of a, when it comes to their main issues is basically regulatory situations and things like that. So I'm not surprised, but we'll see what happens. But like, long-term investment, if you're looking for long-term investment, this is the type of opportunities that we will get as we go along, inshallah. And if you buy it now, and I'm not saying go and buy it right now, by the way, I'm just saying I will be buying more, because I know maybe 5 years from now on I'll look back and I will probably forget the fact that this has happened. Inshallah, hopefully that will be the case. 201 billion market cap right now, wide economic mode, $63 per share right now, dividend yield of 2.3, which is quite nice. Now all of this comes from Seeking Alpha, so it's slightly different to when you look at it simply Wall Street and so on. But the 5-year growth rate for revenue and EPS is really good. Profit margin, return equity, return invested capital, and absolutely amazing. Almost $7 billion of free cash flow right now, 4% when it comes to that free cash flow yield. Total return the last 10 years, 8%. Growth estimate for revenue next year, they're expecting 7%. 16% when it comes to EPS, 17% discount right now, $78 per share is where they think the price should be. And if you look at Seeking Alpha, you can see here we got 6 buys, 6 strong buys, 4 buys, 1 hold, no sales whatsoever. $90 per share, that's what they think is right now, about 63. That's about 43% upside from where we are. A company that is growing double digits, okay, when it comes to EPS for the next couple of years, and then almost basically double digit, high single digits in 2025 onwards, which is quite nice to see. So like I said, whatever they're going through, I'm sure that will pass very soon. The next one is NXP or basically NXP Semiconductors. And this is one of the semiconductor companies out there, 56 billion market cap right now, wide economic moat. All of these companies have a wide economic moat. That means they have a competitive product basically, and they have a basically when it comes to the competition, they're the main companies when it comes to certain things, especially with this one basically, and also these two here, as well as to be honest, they got Keytrudia and so on. They've got other drugs basically in oncology and side of things. So yeah, all of them have something that other companies do not have. $217 per share, 1.8 when it comes to dividend yield, 30% when it comes to the payout ratio, 29% when it comes to the 5-year growth rate, which is absolutely amazing. And they have only been paying that dividend or increasing that dividend last 5 years. $4.06 is what you will get. Dividend safety of A right now. 5-year growth rate, we're looking out for the revenue, 8%. EPS 49%, profit margin, return equity, return invested capital, really wonderful. $2.5 billion of free cash flow right now. That's 5% free cash flow yield as well. Total return the last 10 years, we're looking at about 13%. Revenue they're expecting to grow about 1%, and then EPS about 2%. 25% discounted right now. $300 per share is where they think the price should be. If you haven't pressed that like button already, please do so. It really genuinely helps the channel, and join us in the Patreon account, inshallah. Now, in terms of in the ratings from Seeking Alpha, as you can see, we've got strong buys 14, 7 buys, 10 holds, 1 strong sell, and that's about $266 per share. That's about 23% upside from where we are right now, and according to them, it's about 25%. So very, very similar in terms of the price expected to the price they expect to grow to. So yeah, 5 different companies all have wide economic moats. They solid businesses with excellent free cash flows, and all of them discounted right now. So if you're looking for something to add to your portfolio, that's your starting point. Of course, as always, do your research. And for this one here, you can watch my last video where I talked about this quite detailed. Have a look at that, inshallah. And when it comes to Shariah compliance side of things, as I always shared with you guys from Zoya, as you can see, there's no issues with any of these companies. Okay, if you have not joined us at the Patreon account, please do so. Like I've always said to you guys, it really helps massively when it comes to paying for all the subscriptions that we use, inshallah. Have a wonderful day. Assalamu Alaikum.